Hello everyone, this is Arjit Chatterjee recording our weekly session for Chartsarefun. This is for the week of March 2nd, recording this on the evening of March 8th. Today we're going to talk about the hugely outperforming emerging markets. We'll look at the top performing sector or country in that emerging market, South Korea, and then looking at Brazil as well as Taiwan, and then the iShares MSCI Emerging Market ETF EEM. We'll look at all of these top performing ETFs and show over the last 6 months how they absolutely outperformed the US markets. And then last week, they all had an aggressive pullback. So look at some of the charts and see where they could be headed. And then correlate this to the US dollar. We know that when the US dollar strengthens, the emerging market sectors typically have negatively correlated. They don't do so well. So if we look at the USD, the US dollar, which is a market basket set of currencies against which the US dollar is tracked, and it trades as USD. So it's the forex exchange. And then the long-term chart of US dollar. By long-term, we're talking about not just the monthly or daily, we're talking about the quarterly chart where every candle is a quarter. And then finally look at, we know that with the Iran war, oil prices are shooting up overnight. It's going to go be up 20%. So it closed around $90 last Friday. Today it opened up north of 108, so 20% overnight or over the weekend. And we'll see where the CRB index, which is the Commodity Research Bureau, CRB Chicago trade, is where the commodity trades, where the CRB could be headed long term. So look at that quarterly chart. Without further ado, our Substack's blog site is chartsarefun.substack.com, and our YouTube site is also Chartsarefun. We do believe that charts have tremendous, fun insights, and we hugely appreciate you subscribing to both the blog site and the YouTube channel. And when they do come out, you get to, get the latest releases. So we talked about South Korea, and this is the relative chart of multiple emerging market ETFs compared to the top US ETFs, QQQ, which is the Nasdaq 100, and the S&P 500 SPDRs or SPY, the Magnificent 7 ETF MAGS, and then the two underperformers here are actually, though they fall under the emerging market, they are way more developed than they are in the other emerging economies, which is India and China. They have been laggards. So this is a 6-month chart, and if we can look at the topmost performer, that was South Korea. We can see how absolutely parabolic it went up to 110% in a duration of 6 months, and from that 110%, it pulled back to 77%. So you're talking about close to 33%. So 110 to 77, close to 33 or so pullback in the last week. And then, so right now, over 6-month period, still performing at 77%, but it had a very sharp correction last week, over 30%. And then the Brazilian ETF EWZ, that also was outperforming, not as much as the South Korea. It was up over 40%, and from there it closed near the 28% or so. So that also pulled back. And then the next two, almost one on top of the other, is the Taiwan ETF. And then right below it is the emerging market EEM. Now we know that the biggest player in the Taiwan is the Taiwan Semiconductor, TSM. That's a huge beneficiary of all the AI spending, all the chips that are being manufactured by them to power the AI economy. And then in South Korea, the biggest players are Samsung and Hynix. Those companies make the memory chips that have been absolutely seeing ballistic demand with all the data center growth powered by AI. There's been shortage of supply, and as a result, we've seen even in the US listed stocks, SanDisk, or for that matter, Western Digital or Seagate, they all have powered higher. And so in a similar ways, in South Korea, the Samsung and Hynix have powered their, the index, the Kospi index at a huge parabolic climb. So that was the drop that we got last week across all the 4 emerging market related ETFs that we see. And then the India, China were not spared. They were literally on top of each other, as we can see in so far in the March. And they are down over the 6-month period, down over 4%, 4.9 or so. We can see in the India, the iShares India ETF, INDA, and then the large cap iShares China 5.5% FXI. So now, if we look at the EWY, which is the South Korea's daily chart, we can see this parabolic climb up to 154, and from there a sharp drop very close towards its 50 period moving average. The 50 period, as you can see, is 120, and the lows of on Friday was at 128. Sorry, 121. So it came within a dollar or so of the 50 period moving average and then had a bounce. This bounce we can see potentially could climb a little more higher, and then from there we expect this to collapse and come down and test the rising 200 period moving average, which is closer towards the 88 level. If you take a 120 to a 154 or 121 to a 154, that's $33. Subtract 33 from 121, you get 88, which is right where the rising 200 period moving average is. So that's where we think the South Korea EWY ETF is headed. So we just would suggest caution in buying the South Korean stocks, or for that matter, the ETF itself. That said, the two largest emerging market components, India and China, these are the, talk about the economies of the world, extremely strong power economies. This is an inverted cup and handle. So we can see FXI, the cup formed, then a shallower handle, then the breakdown. So from a 38 to a 40, one or so, that's $3 subtracted from 38, 35. So that's where we think it's headed. It tested a 35.55 within 50 cents of the target. It could likely be met, and then from here we think there's a potential possibility that perhaps from an oversold, we can see RSI's oversold, we can see MACD's oversold, that it could get a counter trend bounce in FXI. So China, for our purposes, look potentially ready for a reversal. So if you are looking at emerging markets, China could be a place to look for some upside. India, in a similar way, has a breakdown. This is more of a dome-shaped breakdown. So from a 51 to a 56, that's roughly $4. So $4, say 18 cents or so, subtract that from 51.83, that's $47.65, which is not too far from the 47.60 that it tested in the April around. It was not in April, it was actually in the early March low in 2025, around 47.60. So that's where we think it could have a double bottom test, and then India could actually be a potential buy, because this could then be a W-shaped double bottom. We could see how, if we can set positive divergence, if we have a higher low in RSI when this 47.65 tests, and then potentially a climb higher is possible. Because remember, India as an economy is doing extremely well, very strong GDP growth, and if they're still pending to make a deal with the US, if for some reason they don't make that trade deal, it could be very bullish for the Indian economy and the Indian stock market. So that's perhaps potentially, we are right now still quite far away from that 47.65. We are within a couple of bucks. We close near 50, 49.99. So we should look for a little more downside on that INDA, and from there potentially a double bottom, kind of a W-shaped double bottom test, and then a breakout higher is possible. EEM, which is the iShares MSCI Emerging Market ETF, that right now is kind of a double bottom test at 56.7 that it tested early March, and it retested that. If we get some upside, and we can see it's deeply oversold on the on the MACD histogram, on the RSI it's come down to 35, 36. It could potentially have a bounce possible, and because EM is heavily weighted by the large Chinese companies, the fact that FXI is getting closer towards an oversold bounce, if the FXI bounces, EM could get a bounce from it. So EM potentially could have a near-term bounce. But that said, if you take a very long-term chart of EM, that is a shooting star, a very bearish shooting star candle pattern. This is every candle is a quarter, and this potentially, if you look at long-term charts of EM, we can see that from the 12 to 37, you're talking about $25 difference from 12 to 37. When it broke above that, 25 plus 37 is 62. It had met that. It tested and met 65.96. It exceeded the target, left a long tail, reversal tail, small body towards the bottom. This is a classic bearish reversal, shooting star reversal pattern on a quarterly chart. So we'll see where it ends. We still have, by end of March, the quarter will end. So we still have a couple of weeks left in March for the month to end. But by the time, if it still ends with a small body here towards the low end of the range, leaves that long tail, that's a reversal pattern. And we've seen those reversal patterns in the previous pullbacks in EM. We've seen a shooting star candle right here, kind of a spinning top, kind of a candle here, here. So whenever you leave these long wicks and then the reversal happens, signals some form of a topping pattern. So that RSI is right at 70, MACD is at above 4. Potentially there is a possibility that EM long term may not be a good time to buy now. This quarterly pullback, this quarterly bearish reversal candle indicates safer to stay away from it. Now that correlates with the US dollar. If you look at the US dollar, that could be on the daily chart forming an inverse head and shoulder. It's testing a key resistance level at 99.6. The bottom of the inverse head and shoulders at 95. So 95 to 99, that's 4. These are not dollars, these are 4 points. So if it takes 4 from 99, it can go to 103.6 or so is where this inverse head and shoulder. So near term though, we are testing a key resistance level. We could have a pullback towards the 97. And as that pullback comes, that would give the emerging markets a bounce because they are inversely correlated. Whenever the dollar's weak, emerging markets, get some strength. So that's potentially a possibility. And then if you look at the longer term chart of US dollar, this shows a bullish cross of the 50 period. This is every candle is a quarter. On the quarterly chart, a key level that it tested successfully is with the 50 going above the 200 period, right at that 96 level. So 96 is where it tested successfully. Last 3 quarterly candles, it's kind of narrow, but in a process of bottoming and reversing higher. If that does reverse higher, dollar could have a very bullish future in the next several quarters. If you look at the pattern from 70 to 114, that's 44 points. Add 44 to 114, that's 158, 160, which is takes us back to the level of the late 80, like mid 85s, 84, 85 is where the dollar was trending at that time. A potential possibility of the dollar getting that kind of that early 80s kind of a climb is definitely possible for us to look into. And this bullish cross is what gives us kind of confidence that potentially dollar could be setting up for a bullish play here in the next several quarters over the next few years. CRB, we talked about the oil prices because of the Iran crisis, the Iran attack shooting up over 20% rise in the weekend from 90. It has already come up from the from the 60s, 70s, shot up to 90 just in the last week of the Iran attack. And now over the weekend, as the war escalated, the oil fields were hit over the weekend. Oil prices shot up 20% to over $108 per barrel. And that's the West Texas crude. So that potentially, if you look at the CRB long-term chart, breaking the 350, the next level of resistance is 366 from the 2006 timeframe, and then the 370 temporarily in 2011. So that's potentially where we think it'll hit resistance, and from there we shall see if it ends the month with some form of a reversal like we saw in the previous. Whenever tops form, it pulls back and closes below from where it peaks. So we shall see where the month right now, it's a very bullish candle for the month of March. We can see from right below 300, it's scaled to 352. You're talking about 17% climb in just this month. And CRB, by the way, is a commodity index. There is many commodities, ags are in there, basic materials are in there, precious metals are in there, but the biggest percentage, the weights on the CRB is energy. Energy holds almost 75, 70, 80%, and then the rest are much smaller percentages. So that is what's causing this to move significantly higher because the oil price is shooting higher. So potentially just by this week, because if oil is going to be up 20% over the weekend, we can expect this to be shooting towards that 370 level. So we'll see where CRB ends tomorrow or in the early part of this week, and then we shall see if oil prices do start pulling back. Potentially CRB could also pull back and end the month a lot below the peak that it tests. But if you look at the MACD histogram, that was gearing up for a bearish cross. It, however, was almost getting ready for a cross below the center line. And then this month, because of the sharp climb, it started climbing. But we have seen that in the past. Look at in the 2007, 2008. It only temporarily climbed for a couple of quarters. And then right there, this is quarterly, by the way. This is, as you can see, it's a quarterly chart, and then it started declining. So this could be a temporary climb quarter for a few quarters, and then down could be the decline as we got in 2008, 2009, and a very sharp pullback is possible. So we think potentially this 366 to 70 in CRB, not too far from where we are, we're 352, could be a solid resistance. And from there, as the CRB pulls back, the dollar could have a rally inversely correlated. When the dollar rallies, commodities pull back, and vice versa. So potentially, if the dollar is setting up long term for a bullish cross and a climb, that would mean the CRB is setting up for a peak and then a pullback is what we think could have happened. So with that, just to sum it up, Korea, if you look at the relative performance of the last 6 months, the key leading emerging market um, country was South Korea, EWY, that has had a 110% climb over the 6 month till last week, and from the 110 came down to 77. Brazil followed it with it. It came from over 40% to 28%. And then we can see Taiwan and EEM also pulling back right neck to neck. And then we can see the QQQ and SPY kind of almost neck to neck because, as you know, it's weighted by the top $1 trillion plus stocks, and that kind of neck to neck are at that 4.5%. MAG 7 has already started underperforming, and we can see that the MAG S is underperforming the QQQ and SPY. And so that's the MAG S. And then the two worst performers in this relative performance chart is the two largest China and India, and both are at minus 5% over the 6 month duration. That said, the Korea ETF EWY could have a near-term bounce. It already got a bounce on Friday, could have further to climb, and then from there break down. We potentially think this is headed from the breakdown below 121, 154 to 121 is $33. Subtract 30 from 121 takes us to 88. That's exactly where the 200 period moving average is. We think that's whenever you have parabolic climbs, they usually decline back from where they start, which is started from 88. We wouldn't be surprised if the crisis of the war continues. There are, right now huge fears of recessionary fears and so on. If the overall economy starts slowing down and disruptions start arising, we wouldn't be surprised to see the South Korea index pull back and test from the correction a level at 88 is what's possible. However, on the positive side, FXI, which is the China large cap ETF, seems to be close to a very key test of, the call it the inverted cup and handle pattern at 35. It's just tested it, started climbing a little bit on Friday. We could see it upside. Alibaba's earnings is coming up. That's the largest component of the FXI. Could start leading it to some upside in the next few days or so. India is also potentially for dome-shaped pattern with the bottom near 4765, very close to the bottom that it had in March of 2000, late February to March of 2025. That could be a double bottom test, and from there, if India's GDP is strong, its growth is quite strong, if India makes a deal with the US for some on the trade side, this could be a double bottom test, and from there climb higher. So India could be a potentially very good buy once it reaches that 4765 or so, which is like about $2, a little more than $2 from 49.99 to 47.65. $2.30 or so is where India could be setting up. The INDA iShares ETF could be setting up as a buy. EM, on the other hand, is near term a double bottom at 56 and could reverse higher. We can see the MACD is deeply oversold on the histogram, and potentially that could be some near term upside. But the quarterly long term chart is printing a very bearish reversal candle. We call this a shooting star candle, like we've seen in the previous peaks, like in 2020, 21, like we've seen here in 2007. So that could be long term not a good play to be on EEM, and potentially be looking for an EEM to kind of underperform and pull back over the next several quarters. So we would not, even if you do play these, it's good to only play near term and not look at emerging market as a good long term play. And that correlates with the US dollar. US dollar near term is testing a key neckline at 99. Pull back to 97 to form a right shoulder, and that inverse head and shoulder from 95 to 99, 4 points added to 99, 103.6, 103.7 is where it could head. Longer term chart on the quarterly is a lot more bullish. This is the 50 period climbing above the 200. We can see this bullish cross. We see it pull back to test that exactly the 95, 96. And if it can reverse higher, That potential cup and handle from 70 to 114 is 44 points, added to 114 is 158. That takes us to that 158, 160 level from the 1985 period or so, is potentially where we think dollar could strengthen in the next few years. So that would mean that if the dollar has to strengthen, commodities will likely have a peak near term and then pull back. We can see it's almost there to key resistance level at 360, 670. We see that the oil price has shot up 20% over the weekend. We'll see what CRB does this week. It could top out there and then from the next few quarters start pulling back, inversely correlated with the dollar climbing. If the dollar climbs, the commodities typically start pulling back. So we expect that to happen over the next several quarters or so. That good luck investing. We'll talk to you next week.
We are not registered investment advisors and encourage our users to consult with their financial advisors before making investment and trading decisions. Nothing contained in our content constitutes a solicitation, recommendation, endorsement, or offer by us at Chartsarefun or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction.